Hi everyone, my name is Craig West, CEO and founder of Succession Plus. And on today's webinar, we're going to talk specifically about employee share ownership plans and which one is the right one for your business and your circumstances. There are a number of different employee share ownership plans that you might use in Australia for your business. Four that we mainly focus on, but there are also others that you might use as well. But I'm going to go through these four and talk about the different features for each. And in fact, some of them have got requirements. For example, the startup plans, you have to actually qualify as a startup, otherwise you can't use them. But we're going to go through those and just have a look at the different features and benefits and work out which one might be the best plan for you to use. Let's start with the startup plan. These were introduced when the government changed the employee share plan legislation back in 2015 for startups, although that name's a little bit misleading and confusing because you don't actually have to be what most people would consider a startup to qualify. From a business point of view, firstly, you can't be a listed company on any public exchange. You have to have aggregated or grouped, if you like, turnover of less than $50 million. You must be less than 10 years old, so that will preclude some people. And you must also be an Australian resident taxpayer. Now, lots of our clients qualify for those four rules or qualifications in terms of the company. If you meet those four, then you also need to meet the following five. Each employee must have less than 10% of the shares or voting rights. They must actually be an employee of either the holding company or the subsidiary. You can only sell the shares to employees at something less than a 15% discount. The employees must hold them for more than 3 years, and the plan must be available to 75% of employees with more than 3 years service. Now, if you qualify for all of those criteria, all 9 of those tests, if you like, then you are eligible to set up an employee share plan under the startup rules. And the startup rules are quite attractive because of the taxation treatment. There are significant tax benefits to using the startup rules. And so the tax rules are simply, there's no upfront tax and no tax on vesting or exercise if you're using options. The only way that employees are taxed is on disposal of the shares, and they still get the CGT 50% discount having held them for more than 12 months. So these are quite attractive from a taxation point of view for the employees. You just have to meet those 9 criteria. And when businesses meet those 9 criteria, most occasions we would recommend they go down that road because the startup plan taxation treatment is quite attractive. Sometimes that's not the case and you don't meet those criteria, or you need to design a specific plan that does something a little bit different to what you can do with the startup plans. And so let's look at some of the other structures that are available. Performance rights plans are simply a plan where we give employees the right to acquire, sometimes at a discount, or sometimes even be gifted shares in the business, but they only get that right if they perform, and hence the name, performance rights plan. They have to achieve certain performance criteria to acquire the right to get the shares. So for example, that might be a certain level of profitability or a certain turnover or certain growth or shareholder return, etc. And as soon as the executive, this is often used for very senior people, CEOs, CFOs, senior level roles, where we can set some criteria. If the CEO achieves $5 million profit or $10 million turnover next year, then they have the right to acquire 1,000 shares at a discount. Or they might even be granted 1,000 shares or gifted those 1,000 shares. Simple plans, generally, fairly easy to implement, not as expensive as some of the more complicated plans, but they are entirely focused on performance. So where you've got performance criteria that are critical, then you can structure a plan using this model. It works quite well to drive performance, particularly for a small number of executive staff. Deferred tax plans. The tax office also, or the government also, back in 2015 introduced the new rules around deferred tax plans. This is particularly for businesses that don't qualify under the startup rules, where they have to use some other kind of plan. Not as advantageous in terms of taxation, because there still is a form of tax, but it's able to be deferred, and hence the name again. Let's have a look at them. Firstly, you can defer taxation in an employee share plan. You have to have one of two things. Either there's a real risk of forfeiture, and that means the employee could literally lose the asset or the shares, Or the scheme is a qualifying salary sacrifice arrangement. So I agree to salary sacrifice an amount of my salary into the employee share plan, then I can defer the tax on that. Now, there is a limit. You can defer the tax, but the maximum deferral period is 15 years. Now, that's quite a long time. And for many businesses, that's more than enough time to lock in and retain key employees and achieve some kind of liquidity event where everybody benefits from the employee share plan. So importantly, that deferral does mean you still pay tax down the track on the amount of shares that you receive, but simply you can defer that out over a period of time. And again, to do that, the taxing point only arises if there's no real risk or there's no genuine restriction. As long as you've got one of those, you can continue to defer, as I said, up to a maximum of 15 years. Now, in most cases, those plans don't quite do what our clients need. And so we've taken a fair bit of time and effort to design specifically what's called a peak performance trust. It's an employee share ownership plan specifically designed and created by Succession Plus for use by Australian privately owned companies to attract, retain and motivate key employees, and to find a way to allow those employees to benefit from the growth in equity value and the income derived by the company they work for. The underlying premise of this is to get employees to think and act like business owners. The best way to do that is to have them actually own shares. And so the Peak Performance Trust is a structure that we've designed that allows them to do that. The business simply commits to investing money into the trust, but it sets some rules around how that works. And it also specifically says that the only thing that that money can be used for is to purchase equity in the company. And so the employee share plan works on that basis. Significant benefits for both the employer, the company, and for the employees, but ultimately it's an incentive tool and it's a retention tool. We're using these plans to attract, retain, and motivate key employees within your business. How does it work in terms of practice? We've got two shareholders here, mum and dad of this company. We set up our Peak Performance Trust in the middle there, and we invite our employees to join the Peak Performance Trust as members. Significantly, the only thing the Peak Performance Trust is allowed to do is buy shares in the company. And that's fairly important because it means that whenever the shares in the company increase in value, automatically the shares in the Peak Performance Trust increase in value as well, because that's the only thing it owns. Let's have a look at the practical example. Firstly, we've got mum and dad shareholders in Smith Engineering. On the right-hand side, we set up a corporate trustee and this new vehicle that we call a Peak Performance Trust, which is in fact a special type of unit trust. We invite, in this example, 4 employees to join, and we set some rules about what they might have to do before they qualify to join. Most commonly, maybe 12 months or even 2 years of service and achieving a certain level of performance. The simple mechanism is Smith Engineering agrees to share some of its profits, normally profits above a benchmark, not from $0, to the Peak Performance Trust, and the Peak Performance Trust can only use that to buy equity in Smith Engineering. And the only place it can buy it from, obviously, is mum and dad, who are the existing shareholders. Let's have a look at an example. We've got John and Jane on the left-hand side, the shareholders in Smith Engineering, which is the employer. We set up our Peak Performance Trust in the middle, and we invite our employees to join. We've set some rules about the profit share, and simply, for the financial year ended 2018, our benchmark profit is $500,000. That's important because it means that under $500,000, nothing actually happens. We have to achieve that base level of performance before we contribute to the profit share, or before Smith Engineering contributes to the profit share. We agree, though, once we get to $500,000, we'll contribute 20% of our profits above that to the employee share ownership plan to buy equity. So we get to the end of the year, step 1 on the top right-hand side, we've actually made a net profit of $600,000. Our benchmark was $500,000, so we've exceeded it by 100. 20% of that is $20,000. And right down the bottom on the left, we actually physically pay from Smith Engineering $20,000 to the Smith Engineering Peak Performance Trust. For those of you interested in tax and accounting, that's a deductible expense to Smith Engineering, but it's not income in the hands of Smith Engineering Peak Performance Trust. It's not income to the employees yet either. The only thing the Smith Engineering Peak Performance Trust is allowed to do is buy shares from John and Jane, and it uses the $20,000 to buy 2% of the shares. That's obviously based on a valuation. That's how we've worked out the value of those shares that can be purchased. Now we have the situation in step 4 on the bottom right where the Peak Performance Trust now holds shares on behalf of the employees in Smith Engineering. We've got those 4 employees in the share plan now owning only 2% because it's only year 1, but gradually over time that will increase as we contribute more profit share. Smith Engineering Peak Performance Trust uses that to buy more equity. It's also important to note we've got 2 significant things happening here. Firstly, if Smith Engineering declares a dividend, then the employee share plan will receive its percentage of the dividend as part of the plan. Secondly, we've now got employees not only receiving income, their salary or their existing payment arrangement, they're now receiving income in the form of dividends, if the dividends are paid and when they're paid. Generally speaking, they'll come through with franking credits, so the employees get that benefit. But we've now also got employees getting something new and different, and that is any increase in the value in Smith Engineering automatically increases the value of the Peak Performance Trust. And so employees are getting a combination of income and equity from the business through the Peak Performance Trust, therefore becoming a lot more like John and Jane. They hold the same type of shares, they've got the same rights, etc. And so they become much more aligned with the existing business owners. The Peak Performance structure is really the ultimate employee share plan for privately owned businesses to get their employees to think and act like business owners. I hope that's been helpful. There are other webinars in this series covering off on employee share plans, why they work, and some of the performance data you can expect from them. I hope that's been helpful. Look forward to helping you implement an employee share plan when the time's right for your business.